A janitor making $32,000 a year bought his first rental property at age 47. Everyone told him he was crazy. He had no savings, no connections, no degree in finance. 11 years later, he owned 11 rental properties. He retired at 58 with more monthly income than his boss, who had worked there for 30 years.
His name was Ronald Reed. And no, he did not win the lottery. He did not inherit money. He used a system that has been quietly building millionaires for over 100 years.
And today, we are going to break that system down for you piece by piece. It is called the 4-pillar framework. And by the end of this video, you will understand exactly how real estate builds wealth in ways that nothing else can.
Now, if you already know the basics of real estate, good. This video is not going to waste your time with surface level advice. We are going deeper. We are going to show you the actual engine behind real estate wealth, the mechanics that separate people who buy one property and quit from people who build empires.
So here is what we are going to cover. 4 pillars. Each one is powerful on its own, but when you stack all 4 together, the math becomes almost unfair.
And I am not exaggerating when I say unfair. When you see how these 4 pillars compound on each other, you will understand why 70% of the world's millionaires built their wealth through real estate. Not stocks, not crypto, not startups, real estate.
Let us start with pillar number 1, cash flow. Cash flow is the money left over after you collect rent and pay all your expenses. Your mortgage, your insurance, your property taxes, your maintenance, your property management fees. Whatever is left, that is cash flow.
Let me give you a real example. Say you buy a duplex for $250,000. You put down 20%, so that is $50,000. Your mortgage payment, including taxes and insurance, comes to about $1,400 a month.
You rent out both units. Unit 1 rents for $950. Unit 2 rents for $1,000. That is $1,950 in total monthly rent.
Now subtract your mortgage payment of $1,400, subtract another $150 for maintenance reserves, subtract another $100 for a vacancy reserve. You are left with $300 a month in cash flow.
$300 a month might not sound like a lot, but here is what most people miss. That is $300 a month for doing almost nothing. You are not trading hours for dollars. You are not commuting. You are not answering to a boss. That money shows up whether you are sleeping, traveling, or watching this video right now.
And $300 a month is just one property. What happens when you have 5? That is $1,500 a month. 10 properties, $3,000 a month. $36,000 a year in passive income. That is more than some people's entire salary.
But cash flow is only the first pillar. And honestly, it is the one most beginners obsess over while completely ignoring the other 3. The third pillar in particular, that is the one that separates the amateurs from the professionals. We will get there in a moment. Pillar number 2, appreciation.
Appreciation is the increase in your property's value over time. Historically, real estate in the United States has appreciated at an average rate of about 3 to 4% per year. Some markets much higher, some lower.
Let us go back to that duplex you bought for $250,000. If it appreciates at just 3.5% per year, in 10 years your property is worth approximately $353,000. That is over $100,000 in wealth created just by holding the property.
Now, there are 2 types of appreciation. Natural appreciation, which is the market going up over time due to inflation, population growth, and demand. And then there is forced appreciation.
Forced appreciation is where it gets really interesting. This is when you increase the value of the property by making strategic improvements. New kitchen, updated bathrooms, adding a bedroom, improving curb appeal. You are not waiting for the market. You are creating value. A $30,000 renovation can add $80,000 in value to a property. That is not a theory. That happens every single day in markets across this country, and that is the power of forced appreciation.
So now you have 2 pillars working for you simultaneously. Cash flow is putting money in your pocket every single month. Appreciation is growing your net worth every single year. Most investments give you one or the other. Real estate gives you both at the same time.
But the reason most people never build serious wealth with real estate is not because they do not understand cash flow or appreciation. It is because they never learn the third pillar.
And the third pillar is the one that makes real estate the most powerful wealth-building vehicle on the planet. Nothing else even comes close.
Pillar number 3, leverage. Leverage is the ability to use borrowed money to control a much larger asset. And real estate is the only investment where banks will happily lend you 80 or even 90% of the purchase price.
Think about that for a second. No bank in the world will lend you 90% of the money to buy stocks. No bank will finance your crypto portfolio. No bank will lend you hundreds of thousands of dollars to start a business with zero experience.
But they will lend you $200,000 to buy a rental property. Why? Because the property itself is the collateral. The bank knows that even if everything goes wrong, they can take the property back and sell it.
Here is where leverage becomes incredibly powerful. Let us say you have $50,000 to invest. Without leverage, you can buy $50,000 worth of assets. Maybe some index funds, maybe some bonds.
But with real estate leverage, that same $50,000 becomes a 20% down payment on a $250,000 property. You now control a $250,000 asset with only $50,000 of your own money.
Now here is the math that will change how you think about money forever.
If your $250,000 property appreciates by 4% this year, the property gained $10,000 in value, but you only invested $50,000. So your return on your money is not 4%, it is 20%.
20% on a safe, tangible, insured asset backed by a physical building that people need to live in. Show me another investment that gives you that kind of return with that level of safety. You cannot. It does not exist.
This is what wealthy people have understood for generations. It is not about how much money you have. It is about how much money you can control. And leverage is the tool that lets you do it.
But there is a word of caution here. Leverage is a double-edged sword. It amplifies your gains, but it can also amplify your losses. If your property drops in value or sits vacant for months, you still owe the bank their mortgage payment.
That is why understanding the numbers matters so much, and we will dedicate an entire episode in this series to analyzing deals and running the numbers. But for now, just understand this. Leverage, used wisely, is the single biggest reason real estate creates more millionaires than any other asset class.
Now, before we get to the fourth pillar, I need you to understand something critical. Each of these pillars is working at the same time on the same property. Your tenants are paying you cash flow every month. Your property is appreciating every year. And leverage is multiplying your returns on every dollar you invested.
3 engines of wealth running simultaneously on a single investment. And we have not even talked about the fourth pillar yet. The fourth pillar is the one the government practically begs you to use. And most people have absolutely no idea it even exists.
Pillar number 4, tax benefits. The United States tax code is written to favor real estate investors. That is not an opinion, that is a fact. The government wants people to provide housing, so they reward you with tax advantages that are not available in almost any other investment.
The biggest one is called depreciation. The IRS allows you to deduct the cost of your rental property over 27.5 years. Even if the property is actually going UP in value, the government lets you write off a portion of its cost every single year as if it is losing value.
Let us break this down with real numbers. You buy a property for $250,000. The land is worth about $50,000 and the building is worth $200,000. The IRS lets you depreciate that $200,000 building over 27.5 years.
That is about $7,272 per year that you can deduct from your taxable rental income. Think about what that means. Your cash flow might be $300 a month, which is $3,600 a year, but your depreciation deduction is over $7,000.
So on paper, according to the IRS, you lost money on that property, even though you are collecting rent, even though your property is going up in value, even though you are building equity every single month. The government says you had a loss. You are making money in reality and losing money on paper. That is the power of depreciation. And that is why real estate investors pay less in taxes than almost anyone else in America.
But depreciation is just the beginning. As a real estate investor, you can also deduct mortgage interest, property taxes, insurance premiums, repairs, maintenance, travel expenses to visit your properties, and even the cost of your home office if you manage your properties from home.
And then there is the 1031 exchange. This is a provision in the tax code that allows you to sell a property and roll all of your profits into a new, larger property without paying any capital gains taxes. You can do this over and over again for your entire life, continuously upgrading into bigger and more valuable properties.
No capital gains tax. Let me say that again. You could sell a property for a $500,000 profit and pay zero in taxes if you reinvest it correctly through a 1031 exchange. Try doing that with stocks. You cannot.
We will go much deeper into tax strategy later in this series, but the key takeaway right now is this: the tax code is not your enemy. When you invest in real estate, the tax code becomes one of your most powerful tools.
So now let us step back and look at the full picture. All four pillars working together on that single duplex you bought for $250,000.
Pillar 1, cash flow. You are making $300 a month in passive income. That is $3,600 a year going directly into your pocket.
Pillar 2, appreciation. Your property is growing in value by roughly 3.5% a year. In year one alone, that is about $8,750 added to your net worth.
Pillar 3, leverage. You only put in $50,000 of your own money, but you are earning returns on the full $250,000 asset. Your actual return on investment is not 4%, it is closer to 25% when you factor in everything.
Pillar 4, tax benefits. Depreciation alone saves you nearly $2,000 a year in taxes depending on your tax bracket, plus all the additional deductions stack on top.
Add it all up. Cash flow, appreciation, equity pay down from your tenants paying your mortgage, and tax savings. Your total return in year one on that $50,000 investment is somewhere around $15,000 to $18,000. That is a 30 to 36% return on one property in your first year, while someone else pays your mortgage and the government gives you tax breaks. Now tell me, what other investment on this planet does all of that simultaneously?
And this is the part that really starts to blow people's minds. These returns compound over time. Every year, your rents can increase with inflation. Every year, your property value grows. Every year, your mortgage balance goes down because your tenants are paying it off for you.
In year one, you made $15,000 to $18,000 on your $50,000 investment. By year 5, between rent increases, appreciation, and mortgage paydown, your annual return could be $25,000 to $30,000. Same property, same initial investment.
By year 10, that single duplex could have generated over $200,000 in total wealth through cash flow, appreciation, and equity combined from one property, from $50,000. Now imagine you do not stop at one. Imagine you buy one property a year for 5 years. Each one is doing the same thing. Each one is generating cash flow, appreciating, being paid off by tenants, and saving you money on taxes. That is how ordinary people build extraordinary wealth.
Now, I know what some of you are thinking right now. This sounds too good to be true. There must be a catch. And I want to be honest with you. There are challenges. Real estate is not a get-rich-quick scheme.
You will deal with repairs at the worst possible times. You will have months where a unit sits vacant. You will have tenants who pay late or damage the property. There will be times when the market drops and your property is worth less than what you owe.
But here is the difference between real estate and every other investment. You have control. If your stock portfolio drops by 30%, what can you do? Nothing. You sit and watch. You hope it comes back up. If your rental property drops in value, you can renovate it. You can raise rents. You can change your strategy. You can refinance. You can add a unit. You can convert it to a short-term rental. You are not a passenger, you are the driver.
And that control is what makes real estate the most forgiving investment for beginners. You do not need to be perfect. You do not need to time the market. You need to buy a decent property in a decent area with decent numbers and just hold on.
Robert Kiyosaki, the author of Rich Dad Poor Dad, said something that has stuck with me for years. He said, "Do not wait to buy real estate. Buy real estate and wait."
The people who built wealth in real estate are not the ones who found the perfect deal at the perfect time. They are the ones who bought a good enough deal and had the patience to let the 4 pillars work.
Now, there is one more thing I want to address before we close out this episode, and it is the number one lie that keeps people from ever getting started.
The lie is this: I do not have enough money to invest in real estate.
That is not true. And in part 2 of this series, we are going to prove it. We are going to show you exactly how people buy properties with 3.5% down, how house hacking lets you live for fair eye while building wealth, how seller financing lets you skip the bank entirely, and creative strategies that most investors will never tell you about.
There are people right now buying rental properties with less than $10,000 out of pocket. That is not a fantasy. That is happening every single day in markets all across this country.
But the strategy only works if you understand the fundamentals we covered today. The 4 pillars are your foundation. Everything else we teach in this series, deal finding, financing, tenant management, scaling, it all builds on what you learned right here.
So let me ask you a question, and I want you to answer this honestly.
A year from now, you can be in one of 2 places. You can be exactly where you are right now watching another video thinking about maybe getting started someday. Or you can own your first investment property, collecting rent, building equity, watching your net worth grow every single month.
The only difference between those 2 versions of your future is what you do after this video ends.
If this episode gave you even one moment of clarity, one moment where you thought, I can actually do this, then we did our job.
Subscribe right now and turn on notifications because part 2 drops in 3 days. We are going to show you how to find deals that actually make money, the exact methods, the exact tools, the exact numbers you need to look for. Most people will scroll past this video and forget everything they just heard. Do not be most people. Save this video, share it with someone who needs to hear it, and we will see you in part 2.
This is just the beginning, and the best part of this journey is what comes next.